Welcome to the Explainer. When you're walking through the grocery aisle, do you ever think about the massive company behind it all? Well, today we're diving deep into one of those giants, George Weston Limited. Let's get right into it. So here's the big question we're trying to answer today. Is this company a defensive compounder? One of those safe, steady growers you can tuck away for years. Or is it just an expensive staple? A good business, sure, but way too overpriced right now. To figure that out, we've got to break down the business, look at its strengths, its weaknesses, and, of course, what the numbers tell us. So let's start with the fundamentals.
All right, first things first, how does a company this big actually make its money? Well, its structure is actually simpler and, kind of smarter than you might think.
Okay, so at its core, George Weston is really two giant businesses that are perfectly intertwined. On one hand, you have Loblaw, Canada's biggest grocer. On the other, you have Choice Properties, a huge real estate company that just so happens to own the land that many of those grocery stores sit on. It's brilliant, really. The grocery stores become the perfect, stable tenants for the real estate business. This creates this awesome, self-sustaining loop of cash flow.
So what makes this company a potential compounder? What's the bull case here? Well, it really all comes down to how incredibly durable and dominant its market position is.
This is where we get into what investors call a moat, the stuff that protects a business from competitors. And George Weston's moat is wide. First, its scale is just massive. It would be incredibly hard for a newcomer to build a distribution network to compete. Then you have their private label brands like President's Choice and No Name, which are practically institutions in Canada. They build loyalty and bring in higher profits. And finally, by owning the real estate, they control the best locations. It's a true fortress.
And what does that fortress produce? Well, a whole lot of cash. Just look at this number. We're talking over $3.2 billion in free cash flow in just the last 12 months. Now, that's the money left over after running the entire business, and it's what they can use to expand, pay dividends, and reward their shareholders. And speaking of rewarding shareholders, management has been doing just that. They've used that cash to buy back over 14% of the company's own stock in just 5 years. Every time they do that, your piece of the pie gets a little bigger. It's a huge vote of confidence from the people who know the business best. Okay, but it can't all be good news, right? Of course not. So now let's flip the coin and look at the other side of the argument, the potential risks that have some investors hitting the brakes. See, for all its strengths as a market leader, there are some pretty significant weaknesses to worry about. First, grocery profit margins are razor thin. We're talking less than 2 cents on the dollar. The company is also carrying a lot of debt, which always adds risk. And while the business is stable, it's not exactly a speed demon. You're looking at growth of maybe 3 to 4% a year.
This SWOT analysis really puts it all in perspective, doesn't it? The strengths are clearly dominant at 45%. But look at the weaknesses, 35%. That's a really significant chunk, telling you that while the business is strong, those concerns about debt and margins are absolutely real and need to be taken seriously.
And on top of that, you've got these major external threats to keep an eye on. There's constant regulatory pressure in Canada about grocery prices. You have fierce discounters like Walmart always squeezing those already thin margins. And with all that debt, if interest rates keep rising, the cost of just paying the interest on their loans could go up significantly. Okay, so we've heard the good, we've heard the bad, we have a strong case on both sides. So let's get down to the brass tacks and see what the valuation data tells us. Is the stock actually a good buy at today's price? So what is George Weston actually worth? Well, using a couple of standard valuation models, this analysis estimates its intrinsic value is somewhere between $82 and $88 a share. Now compare that to its recent market price of nearly $96. You can see right away there's a pretty big disconnect there. And this brings us to a super important idea for investors, the margin of safety. Think of it like a buffer. If you figure something is worth $85, you want to buy it for, say, $65 or $70, just in case you're wrong. It protects your downside. But right now, the price is higher than the estimated value, which means there's no buffer. In fact, it's a negative margin of safety. This table really is the key takeaway when it comes to valuation. It answers the question, if I want to make a certain return, what price should I pay? So if your goal is a solid 9% annual return over the long haul, this analysis says you need to be able to buy the stock for around $63 a share. And as you can see, that is a long way from where it's trading today. All right, let's pull all these threads together. We've looked at the business, the strengths, the risks, and the numbers. So
What's the final conclusion from all this analysis?
The verdict from the source material is pretty clear. The business is high quality, no doubt about it, but the price is just too high to get the kind of return an investor should be looking for. So the recommendation isn't to sell if you already own it, but to hold. And if you don't own it, wait for a big market downturn to hopefully get a much better price.
So to sum it all up for you, George Weston is a fantastic, defensive cash cow of a business. But the valuation right now just looks stretched. It seems expensive for what you're getting in terms of future growth. So the strategy here is all about patience. It's a great company to put on your watch list, but you'll want to wait for a much more attractive entry point to come along.
And that's our deep dive on George Weston Limited. So what do you think? Is it a solid hold, or is the price just too rich? Let us know your thoughts in the comments. And hey, while you're there, tell us which company's stock we should break down in our next explainer. We'd love to hear from you. Thanks for watching.